wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you informed of the latest developments in the financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 164, and in this episode we're reviewing the performance of the global markets during the 24th week of 2025, and that is from Monday the 9th to Friday the 13th of June. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Bureau of Labor Statistics reported that consumer prices rose less than expected in the month of May, as President Trump's tariffs have yet to show significant impact on inflation. The lower than expected inflation reading for the month of May suggests that tariffs are not having an immediate impact, and that is probably due to companies using existing inventories or being hesitant to increase prices due to uncertain demand. The Consumer Price Index, which is a broad-based measure of the prices of goods and services across the U.S. economy, this increased by 0.1% for the month, whilst the annual rate of inflation came out at 2.4%. Excluding food and energy prices, the Core Consumer Price Index, which the Federal Reserve considers as a better measure of longer-term inflation trends, this was recorded at 2.8% on an annual basis. And over to China, where China's export growth missed expectations in the month of May, mainly due to a sharp decline in shipments to the United States, which is the result of the ongoing tariff war between the two countries. According to data from Wind Information, Chinese exports to the United States plunged by 34.5% in the month of May compared to the same period last year. Chinese imports from the United States also declined by over 18%, and on an annual basis, China's trade surplus with America shrunk by 41.5% to $18 billion. Staying in China, China's consumer prices fell for a fourth consecutive month in May, as China's stimulus measures appear to be insufficient to boost domestic consumption. According to data from the National Bureau of Statistics, the Chinese Consumer Price Index fell by 0.1% in the month of May compared to the same period last year. The Consumer Price Index slipped into negative territory in February and has continued to post year-on-year declines of 0.1% in the months of March, April, and now May. And in related news, China has announced that it will negotiate a new economic agreement with Africa that will remove all existing tariffs for the 53 African countries with which it has diplomatic ties. This duty-free access to the Chinese market will provide a huge market for African exports, and in the case of Kenya, this means a new market for our coffee, tea, and avocados, hopefully with some value addition in order to maximize our export earnings. On Wall Street this past week, the stock market tumbled on Friday after Israel launched a wave of airstrikes on Iran, pushing oil prices higher and further complicating the delicate geopolitical situation in the Middle East. The market decline began on a Thursday evening as Israel's defense minister declared a special state of emergency following Israel's attack on Iran. And shortly thereafter, believe it or not, U.S. government officials said there was no involvement or assistance from the United States in this attack. In response, the Dow Jones Industrial Average fell by 769 points to end the week at 42,197, whilst the S&P 500 dropped by 1.1% to close at 5,976, and the tech-heavy Nasdaq Composite lost 1.3% and settled at 19,406. In the government bond market, the yields on U.S. Treasuries rose on Friday in the wake of Israel's unprovoked attack on Iran, which drove up oil prices and led to concerns about higher fuel prices and inflation. Friday's move came after Israel launched a series of airstrikes targeted at Iran's nuclear sites, as well as its top military generals and nuclear scientists. In response, the yield on the benchmark 10-year Treasury bond moved up more than 5 basis points to settle at 4.41%, whilst the yield on the 2-year Treasury note rose by more than 4.5 basis points to close at 3.95%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, after trading around a 3-year low on Thursday, the US dollar rallied on Friday as investors moved into safe haven assets following Israel's unprovoked attack on Iran. The attack took financial markets by surprise and pushed up the price of the dollar as investors fled into safe haven assets in order to protect their portfolios from volatility. The dollar's role as a safe haven asset was reaffirmed as it also appreciated against both the Swiss franc and the Japanese yen, both of which are also considered as safe haven assets. The dollar index, which measures the strength of the greenback against a basket of 6 major currencies, increased by 0.3% on Friday and was last seen trading at around 98.19. In the commodity markets, the price of crude oil jumped by about $5 per barrel on Friday after Israel launched an attack against Iran, stoking fears of a wider conflict in the Middle East that could disrupt oil supplies. Israel's attack on Iran is the most significant geopolitical event since Russia launched its invasion of Ukraine in March 2022. The price of crude oil has now risen to its highest level since then, with the global benchmark Brent crude rising by just more than 7% to settle at $74.23 per barrel. Meanwhile, the price of the U.S. benchmark, that is West Texas Intermediate crude, increased by 7.2% to close the week at $72.98 per barrel. In the precious metals market, the price of gold rose sharply on Friday as investors flocked to safe haven assets following Israel's attack on Iran, which reignited fears of a broader conflict in the Middle East. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. According to a report by the European Central Bank, gold was the second largest global reserve asset held by central banks in 2024. The world has also been reducing its reliance on the greenback, with the share of the dollar in global reserves declining from over 70% down to 57% in 2024, whilst gold has now increased to 19%. The price of spot gold came within striking distance of its record high of $3,500 that was set in April, as it gained about 4% this past week before eventually settling at $3,428 per ounce. We now change scene to the Kenyan financial markets. And we start by looking at the Monetary Policy Committee, which met on Tuesday, the 10th of June, and reviewed the outcomes of its previous policy measures that were implemented to anchor inflationary expectations and maintain exchange rate stability. The committee met against a backdrop of elevated uncertainty about the outlook for the global economy. Global growth is projected to slow down to 2.8% in 2025 compared to 3.3% in 2024, and this is mainly due to the ongoing tariff war between the United States and China. Additionally, escalating geopolitical tensions in the Middle East and also between Russia and Ukraine, this continues to pose a major risk to global economic growth. Back at home, Kenya's overall inflation declined to 3.8% in May 2025, down from 4.1% in April. Overall inflation is expected to remain below the midpoint of the central bank's target range in the near term, supported by stability in food and energy prices and continued stability in the exchange rate. The recently released Economic Survey 2025 shows that the Kenyan economy slowed down in 2024, with the real gross domestic product growing by 4.7% compared to a growth rate of 5.7% in 2023. Meanwhile, Kenya's current account, which measures the net difference between imports and exports, this had a narrow deficit of 1.8% of the country's GDP in the 12 months to April 2025, and this was a reflection of diaspora remittances, which increased by 12% in the 12 months to April 2025. The central bank's foreign exchange reserves currently stand at $10.8 billion, which is equivalent to 4.75 months of import cover, and continues to provide an adequate buffer against any short-term shocks in the domestic foreign exchange market. The banking sector remains stable and resilient, with strong liquidity and capital adequacy ratios, as the ratio of gross non-performing loans stood at 17.6% and now was in April 2025. This was up from 17.2% in February. That said, commercial bank lending to the private sector increased by just 2% in May compared to 0.4% in April. This reflects improved demand in line with the declining lending interest rates, as the average lending rate declined to 15.4% in May, down from 15.7% in April. Based on these observations, the committee concluded that there was scope for further easing of monetary policy in order to stimulate lending to the private sector and support economic activity. The committee therefore decided to lower the central bank rate by 25 basis points from 10% down to 9.75%. For your information, the next Monetary Policy Committee meeting is scheduled to take place in August 2025. In the domestic foreign exchange market, during the past week, the Kenya shilling remained static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24 compared to 129.22 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.67 and the euro was valued at 148.17. And on the regional front, one Kenya shilling was changing hands for 27.75 Ugandan shillings and 20.16 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.98. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's foreign exchange reserves increased for the fourth week in a row, and yet again by a significant amount of $357 million for a grand total of $10.94 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any information about the change in foreign exchange reserves. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this dipped by 11 basis points to 9.65% compared to a rate of 9.76% that was recorded the previous week, but remains pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 16.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 12th of June, and the central bank received bids totaling to 56.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 237%. The central bank rejected the bulk of these bids and ended up accepting only 17.1 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 10 basis points to average out at 8.17%, whilst the 182-day rate dipped by about 5 basis points to settle at 8.49%, and the 364-day rate dropped by 24 basis points to settle at 9.75%. In the primary bond market, the Central Bank of Kenya has published its prospectus for the June Treasury bond auction, in which it is looking to raise a total of 50 billion shillings for the stated purpose of budgetary support. The central bank is now inviting bids from the public for the two reopened fixed coupon treasury bonds, whose terms and conditions are as follows. The first bond is a 15-year bond with 9.7 years left to maturity, that is in 2035, and a coupon rate at 12.75%. The second bond is a 30-year bond with 15.7 years left to maturity, that is in 2041, and a coupon rate at 12% flat. These bonds are now open for sale until Wednesday, the 18th of June. Up next is our topical issue, and this week we're looking at the budget highlights for the next financial year. The budget for the next financial year, that is 2025-2026, shows a 6% increase in the total budget, up to 4.29 trillion shillings. The government proposes to finance this budget through revenue collections that are estimated at 3.3 trillion shillings, which results in a budget deficit of 923 billion shillings. The budget highlights indicate that recurrent expenditure, which is mainly used to pay salaries and pensions, will consume the lion's share of the budget at about 1.8 trillion shillings. Meanwhile, interest payments on the national debt will cost the Kenyan taxpayer a further 1.3 trillion shillings, whilst development expenditure, which is critical for economic growth and development, has been allocated a paltry 742 billion shillings. And last but not least, the equitable share to county governments has been slashed by 3%, down to 405 billion shillings for the next financial year. The proposed budget aims to reduce the fiscal deficit from 5.1% of GDP in the financial year 2024-2025 down to 4.5% of the GDP in the current financial year, that is 2025-2026. But given the government's history of failing to meet its fiscal deficit targets, it's highly likely that the fiscal deficit will be revised upwards during the supplementary budgets. The fiscal deficit, which is estimated at 923 billion shillings, will be financed through a combination of domestic borrowing as well as external borrowing. The government intends to borrow 635 billion shillings from the domestic markets, and the balance of 287 billion shillings will be financed from external sources. The government has indicated that it will explore alternative funding instruments such as debt swaps, diaspora bonds, sustainability-linked bonds, and environmental, social, and governance instruments to fund the budget deficit and manage the public debt. In addition to that, the National Treasury is looking to reduce the reliance on debt and taxes and instead utilize the public-private partnership model in order to raise about 70 billion shillings that will be used to finance the gap in infrastructure spending. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the greatest regret is living a life that is not true to yourself. Think about it. Thank you, and God bless.